people that were on the fence about maybe upgrading their house or, downgrading or moving to a different place with rates kind of stabilizing a little further might be incentivized with the equity that they have to roll into another purchase. Again, I don't know if that drives up inventory like crazy, but what I do know is that most of the people that are going to be offering on homes now, they're sitting on a good chunk of equity that they haven't lost.
Great news, folks. The Federal Reserve cut interest rates 50 basis points yesterday, 0.5%. So mortgage rates have to be down 0.5% today. We've got Dustin and Jonathan from Convoy Home Loans. So Dustin, give me the good news, right? Mortgage rates down 0.5%.
Mortgage rates are not down 0.5%, and unfortunately, we have been, predicting this would happen, and it was a bit of a shock in my eyes that they went with the 50 that we'll touch on later. But mortgage rates are always going to be forward facing. This has been built into the rate sheets for the last 3 weeks. And yes, you might see some clickbait out there that'll say mortgage rates did go up, and they did go up very marginally yesterday. But the reason is what we'll unpack in the next 10 or 15 minutes. A lot of was looked into what Powell was saying, a lot on the dot plot chart, and John and I will talk about some conversations we had with a lot of the rate setters that we sell our notes to, and why they kind of are a little bit happy but vindicated, and why they didn't move rates either.
Yeah. Well, let's break this down a little bit, folks. Again, if you watch this channel, you know that I told you, I warned you that after we got the rate decision, that mortgage rates could get slightly worse. They got worse yesterday, likely getting worse today. If you look at the 10-year note, up almost 5 basis points. So would not shock me if mortgage rates went the other direction. I do want to highlight something, though. I got 12. I just counted them. I got 12 emails from lenders who have my email from somewhere. All of them with the headline, mortgage or not mortgage, interest rates cut by the Fed. And then there's a litany of garbage basically saying refi, HELOC, blah, blah, blah. So clearly the body shops in the call centers are not interested in speaking the truth. They're just interested in selling loans and refis. And my fear is there's going to be a lot of people that get into bad refis. That's one of my fears, Jonathan.
Yeah, absolutely. And don't you love saying like "I told you so," right?
Yes, I do. I love saying that. Yes, I do.
um, because we like Dustin and I had conversations with a lot of clients that were essentially waiting for this meeting. They were just holding tight, saying, "Hey, I don't want to really move until this meeting happens. Rates are going to drop." And we're like, "Well, we don't really think it's going to happen." In terms of like dropping in the mortgage interest rate side. So obviously, to your point, that's the headline grabber, right? That's going to grab the unfortunately majority of uneducated American homeowners that have only associate a rate drop, and they see the word rate because that's a trigger word, and they see that and they go, okay, well, now is probably the best time to refinance out of my 2.5%. They make a call, and then they realize, oh, you're Rocket, or sorry, I shouldn't say the name, but whatever mortgage you're trying to you're trying to sell me a loan at, 6.75. Like, okay, I mean, I guess if you're telling me I can wrap in my credit cards and wrap in, my car loan and yada, yada. And then, I guess it makes sense for me to take a 6.75 of my primary residence for 30 years. That's the conversation that's going to happen. Right. And that's what you're kind of alluding to, is you're like afraid of people going into refi with. Like, I've told clients, like, I'd rather sleep, Dustin and I both, we would rather sleep better at night telling the clients the truth and not getting the business than
Yeah,
getting
just
the business and like not having it go the other way. So I've
yeah.
turned down clients like that in the last 2 weeks that have been calling about lower rates, lower rates. So I was like, hey, look, it doesn't make sense for you to refinance right now. Your payment's
Yeah.
going up. Even if you wrap all these things in, it's your primary residence. Why would you want to wrap in all these things for 30 years when you can just continue to pay down your mortgage as is at a 2.75, you
No, I'm
know?
I'm so glad you guys are part of the channel. One of the things that makes me feel good every week, every month with you guys is you tell people the truth. Again, it's always up to the consumer to do what they want, but you got to have people in your corner that are willing to say, no, this is a bad idea, right? Whether that bad idea is negative cash flow, whether that bad idea is a refi that doesn't make sense. And again, these body shops, these call centers, they are just grinding through scripts. They are all about the transaction. They are not about doing good deals. Sometimes a refi makes sense. There are lots of life events, lots of choices where a refi could make sense, but there's also lots that don't. And it's a sad state of affairs that's happening. Well, let's talk about the dot plot, because again, we got the big 50 cut, which I think is wild, right? GDP is 3%. Unemployment's 4.2. Inflation is 2.6. And yet the Fed hit us with the 50. It's only the third time they've started a rate cutting cycle with a 50. The most recent one was the GFC, which should send shivers down our back. Do you guys think the Fed is afraid of something?
Yeah, I mean, that's the only signal you can really get. When I didn't watch it live, unfortunately, I rewatched it last night, and it was interesting to see Powell in a different stance, trying to almost prop up where we are in the economy, right? But do
Yeah,
a
we're
50
strong,
basis
we're
point.
strong, we're strong, we're strong. Oh, here's 50.
Yeah, those don't go in line. I was
I very confused.
yeah, it doesn't add up, and there's a litany of reasons as to why the Fed could be scared. It could be the election. It could be banks liquidity. It could be unemployment. There's a bunch of things that we don't know exactly why the Feds are, I would say, scared and afraid, like you said, and not cautious, which a 25 basis point would have signaled. But looking at the dot plot and why John and I were discussing, I think it was maybe right after work, and why we were happy with the way that it was a bit of a vindication for not only people in the real estate industry, but mortgage and people on the sidelines that look, we've had a rough 4 years since the last, rate cut. It's been rate hikes, and it's been a tough time to say the least. But now looking at the dot plot chart, now officially getting our first rate cut, it's good to know that lower rates, it may not drop another full percent or 2% in the next year, just like it did over the last year. But these lower rates in the fives and the sixes, and dare I say the fours 3 years from now, whatever it might be, that's now here. It's done with the six and a half, seven, seven and a half,
Yeah.
eight, eight and a half, eight, seven and a half, eight. That was a tough stretch, but
Yeah.
it was good to see that yesterday.
Yeah, there's a couple of things that I'm thinking about, and I've said this on my channel. I think I said this first time 2 months, maybe 3 months ago now. The refi boom has started. And I think yesterday's rate move, I think the combination of the dot plot and forward-looking indicators mean the refi boom just continues. I think the last 3 weeks, if you're looking at mortgage business, whatever it is, daily, on the week-on-week basis, up 94%, 107%, and then 124%. These are year-on-year numbers, right? So clearly the refi boom is here. I think it continues. It's the purchase market that is going to be interesting. I think the purchase market will be subdued. We just got existing home sales today, which again, I was right. We took out the cycle low. The cycle low is now 3.86 million. It was 3.88. I do think that will prove to be the bottom. So the good news for mortgage and housing is we have the bottom. I think mortgage is building out faster because you guys have the refi arm. I don't have great news for purchase, but at least there's good news. You're not going lower. What do you guys think of all that? What do you think, Jonathan?
Yeah, absolutely. And I mean, obviously now with rates kind of settling in, and we kind of saw this back in December, January, right? When mortgage rates first started really dipping to the point where it's at right now. Was it December, January? Yeah, I think it was, right? Over the last, yeah.
Yeah.
Everything feels like a blur. But if you're looking back then, right, and people were starting to make offers on houses, people were starting to pick up purchases. A lot of the money was coming from the refis, right, that we initially spoke about back then. That the conversation about refinances have started. But people, I mean, I think, right, people that were on the fence about maybe upgrading their house or, downgrading or moving to a different place with rates kind of stabilizing a little further might be incentivized with the equity that they have to roll into another purchase. Again, I don't know if that drives up inventory like crazy, but what I do know is that most of the people that are going to be offering on homes now, they're sitting on a good chunk of equity that they haven't lost, right? I think, like you said, we've passed, I think, the bottom and the worst. So going forward, if everyone's pulling out all this equity, they're pulling out the equity to deploy. So hopefully that means that purchases
That's
start to speed
that's
up.
the big thing. Again, one
Yeah.
of the things that could help a soft landing is I forget the number, but it was trillions of dollars. We have, I think it was 9 trillion. It might have been 8 trillion. Leave the comments below if you know what the number is. But we have, let's call it 9 trillion in tappable equity. If rates get low enough, and I don't think they have to go much past the fives, there's going to be a lot of people going, I've got 100,000, 150,000 in tappable equity. Do I want to tap that? Do I want to use that for an addition? Do I want to use that to pay off more expensive debt? Do I want to use that to buy another asset? And if enough, homeowners, asset owners see that, this could be the whole soft landing, no landing scenario, because you get the M2 money supply picking up because people are going back and extracting equity. This no landing situation could happen.
Yeah, and let's say right now, with all of the people that have been sitting on the sideline, either trying to refi with their current home that's at 2.25, pull cash, or like you said, my bigger concern is the purchase, market. And ultimately, lower rates are going to drive up demand. But the problem is that the demand is not going to be matched by the supply. And that's the biggest problem that we have. I think the mid five, like right now, the average primary conventional 30 years at 6.2 or something. Okay. Have we priced out things in the five? Sure. Perfect credit, a little bit more down, yada, yada. But that's the average 20% down. I think the middle point, if we get to like 5.5, we'll slowly bring that problem back in. We cross 5, maybe we'll see some supply actually meet that demand. But the 5, 5.25, 5.5, 5.7, that's the rate range that's going to be the biggest problem, because demand will never be able to be caught up with supply at that range.
Funny, Dustin, you brought this up. Just on my daily financial news this morning, I told people that I think 5.5 is the worst 30-year mortgage rate, because 5.5 unlocks a wave of pent up, AKA marginal demand, but it only unlocks a trickle of supply. And if we get 5.5 February, March of 2025 as the spring selling season kicks off, bananas. What do you think, Jonathan?
Yeah, and I mean, I think it's to note, right? Because we get a lot of comments on or calls from listeners, and they're like, "You didn't mention this, you didn't mention that." When you say 5.5 being a bad rate I think for in terms of purchasing power, yeah,
Correct.
I think for sure. But if you're talking about like wanting to refinance to pull out some equity or whatnot,
different question.
That's a totally different conversation. So in terms of pulling equity out to deploy, yeah, absolutely. But like you said, I mean, demand is already high as it is, right?
Yeah.
I think it's been high regardless of the rates. As soon as they started trickling down a little bit, right? Demands have been high. I just put in like 2 other purchases in LA this past week that were over asking. So
wow. Oh my God.
yeah, it's there.
That does not
You
make me
went to
feel
that
good.
same house, John, right? Like a month ago that you went to this past weekend, where it was like a ghost town in the house, and then you went this past weekend, there's like 100 people walking through.
Yeah, it was wild.
Like
Wild.
just in
You
1
mean
month.
rates matter? Rates matter?
Yeah.
Is that what we just
I
learned?
mean, and also it's like I obviously spend a lot of time walking like development projects or like fix and flip type projects as well, and even those, like even things that were off market, I'm seeing more people pull up, and to take a look at the property and whatnot. I mean, we're there.
Yeah. Well, let's get into this, because I think there's one question that I really haven't played with, so we'll play with it together. And that is, what mortgage rates, again, ORaaT, 20% down, best credit. What might mortgage rates be? And again, this is completely guesses. Our crystal balls are as broken as yours. Where might we be at the end of 24 and maybe summer of 25? Again, the Fed has told us, again, according to the dot plot, we have at least 2 more rate cuts coming this year, and that we might have somewhat like 6 rate cuts between now and the summer. Also, just so you guys know, we are still sitting at a very large margin or spread. That spread is still about 65 basis points larger than normal. I think now that the rate cutting cycle has started, we are going to see some compression in that. So we have Fed rate cuts, margin compression. We'll go to Dustin first. Dustin, what do you think a wild ass guess mortgage rates might be? And you know what? I'll give you an easy out. Above or below 6% by December 31st, 2024.
Ooh. But we're going to start with the baseline that right now it's 6.25, average
Correct.
30-year fix.
Correct.
Looking at the dot plot yesterday with, I think it was 16 of the 19 Fed officials basically have 2 more rate cuts, right?
Correct. Correct.
I'll say we'll be at 5.99 barely.
Okay, so we're barely below 6 at the end of 2024.
Next year in summer, I think we're 5.75.
Oh,
Nothing
okay. So
crazy.
we're just like, we're kind of just
That
very,
isn't
very
some
grudge.
Yeah, like my prediction is just as good as everybody else's out there,
Which
and
means
I'm
total
basing it
crap.
off
Yeah.
of based it off the graph. That was the most boring answer I could have given, so I'll let John go a little bit wild on his.
Yeah, I'll go a little wilder. I think if we're starting at 6.25 as the baseline, we by the end of the year maybe 5.8, 5.7.
Okay. All right.
Which, I mean, I'm just basing it off of where we were even 2 months ago versus where we are now, right? And then I think maybe in the next year, I don't think it moves then. I think
Okay.
it maybe 5.8, 5.7, and then it stays there,
Okay.
and maybe 5.6, maybe an
Okay.
incremental move, but I think maybe a stall there.
All right. So I'll play this game as well. So I'm gonna say actually we get to 5.9 by the end of the year. So the December 31st, 21. And then I'm going to go bananas. By the end of 2025, we're sub 5.25.
Wow.
Yeah. And I
I
don't feel
hope
good
not.
about that.
Between you and I hope not.
Yeah.
Yeah. You and me both. I don't think that's a good thing, being below 5.25.
No.
Yeah. But again, I think so how did I get to 5.25? So again, rate cutting cycle. I suspect we have 200 basis points in cuts coming between now and the end of the year. So that's one assumption. And then again, I think it's very easy for me to articulate that the large margin is cut in half. Today, if we round it up to 70 basis points, that means there's 35 basis points just in margin compression. So how
You're
did I get
banking
to
on
5.25?
more.
Yeah. Yeah. So I think that just has to come in. It's a historical norm. Today we're at 265. Historically is 180. I think we end the year at 2.25, or 225 or whatever that is, basis points spread. So yeah, margin compression and 200 basis points in rate cuts, and we get to 5.25. And then I have no idea what happens.
Honestly, that's scary, if it plays out that way. I went hard and then conservative, but you going all the way, like the market, I think, I mean, I don't know if we could take that. We're good. We're in that inflation cycle. I mean, dare I say,
Yeah.
potentially back in that
Well,
inflation
dude, that's
cycle.
my biggest fear is we have a second coming of inflation. We're
Yeah.
repeating the movie. We were so close in my mind to killing inflation. All we had to do was wait another couple of months and the thing would have been dead. And yes, we would have had more job loss and we would have had this. But inflation would have been dead. Now it's like highly injured. But inflation is like this evil superhero that can recover quickly, almost like what is that, death pool or whoever that guy is,
Deadpool.
who just
Not my
Deadpool, whatever the hell his name is. He could just fix himself. And I'm so afraid that inflation comes back.
Yeah, that would be a really big problem. We'd started all over, all the progress that we made the last 4 years. Now we're going to sit through it again. And that's That's why John and I are so concerned about not having rates drop too quick, too sudden. And everybody, I think, at least on the mortgage industry side, will lie that having their paychecks be a little bit larger because of a massive rate drop would be nice, right?
Dude,
But
it
it's
would feel
not good
it
for
would
the
feel
long
good.
term.
No, it would feel good for a moment.
Exactly. It's not worth it.
And then it would be dude, it would be 1981 all over again.
Yeah. And so there was one thing that you threw out at the beginning that I caught, but I didn't catch, that I wanted to confirm with you that I think maybe some listeners didn't hear. You said this was the third time that the Feds have cut rates by 50 basis points to start a rate. Okay. What years were those? I know you got some facts behind you.
Yeah, so the last one was the Great Recession. It was actually the same day, September 18th, 2007. How is that for
Really?
Yeah.
September 18th?
September 18th, 2007 was the last time. And then I believe it was a dot-com crisis, but I haven't validated the second date. But yeah, the last time we did this
How about that?
was September 18th, 2007. That should just send
I got
shivers
the
down your
goosebumps.
spine.
I know you can't see, but I literally just got the
That's
goosebumps.
crazy, right? Yeah,
Yeah.
I did too. I'm like, this is a bad omen. This is a bad omen.
Well, that's wild.
Jonathan, yeah, Jonathan, what do you think of all that?
I mean, I think, you know, as we're talking the whole interview, I'm getting calls like crazy left and right, which is why I'm like, keep looking down. It just doesn't stop right now. I got like 5 calls at once. Probably about the same topic that we're
Yeah,
talking about.
rates are down, right?
Yeah. So I think the obviously it's extremely scary to say and to think that, you know, history repeating itself is one of the worst things that can happen, right? And the reason we study history is to not repeat it. Unfortunately, I mean, we might be back in that case. Hopefully not, right?
Yeah,
Hopefully things are
you know,
different.
I hope we stay at 5.7, 5.8. If we stay at 5.7, 5.8 for the next 2 years, done. Great.
That's why I said it though, because it was more of a hope thing, right? And it's
So,
the same thing we talked about every single video. Like, I'm not one of those, especially me and Dustin, like we're not one of the ones that are like, yeah, let's drop rates, let's cut it, let's, so that we're not looking out for our own pockets, right? We're not trying to do that, right? What we want to do is make sure that we are here for a long time, not a short
correct.
time for a party, right?
Yeah.
So
All right, way to go.
I think that has to be the main thing and the main focus for a lot of people is really just watch out in the market. Don't make rash decisions just because of what's happening, right? But also don't be eaten up by fear of repeating history, because you have to take advantage of what's happening in the market to make the right, you know, financial decisions for the future. So yeah,
Yeah.
definitely.
Well, the other thing I would tell folks, you're going to get bombarded with emails, probably phone calls from call centers telling you to refi, singing the song. I strongly suggest you work with people that are willing to tell you, no, that is not good for you. If somebody wanted to reach out to Convoy Home Loans, how do they do that?
Go to convoyhomeloans.com and let us know you came from ORaaT.
Again, tell them you came from ORaaT so you get Dustin and or Jonathan. If you don't, you end up in a queue and you don't want that. Thanks, guys.
Thank you.
You.